Welcome, partners and fellow investors. Today we explore the fundamental architecture of value, the dividend discount model. When evaluating high-growth opportunities, we often look for the next unicorn, but sophisticated capital understands that the bedrock of any portfolio is the stable payer. These are companies that offer predictable, high-quality cash flows. Our goal today is to move beyond market sentiment and use the DDM to uncover the true intrinsic value of an asset. We aren't just looking at stock price movements. We are looking at the present value of all future dividends. For a VC or angel partner, this model provides a mathematical floor to our valuations, ensuring that we are investing in businesses with sustainable payout structures and not just speculative fervor. Let us dive into why intrinsic value is the ultimate North Star in a volatile market environment. At the heart of our valuation strategy lies the Gordon growth model, a specific iteration of the DDM. The formula P equals D1 divided by the difference between R and G is elegant yet powerful. D1 represents the expected dividend next year. The variable R is our required rate of return, representing the opportunity cost and risk we undertake. Finally, G is the constant growth rate of those dividends. For a stable payer, this formula acts as a filtering mechanism. If the market price is significantly lower than the P we calculate, we have found a value-rich entry point. This formula allows us to quantify the exact premium we are willing to pay for a company's growth. By mastering this math, we move from guessing to calculating, providing our partners with a rigorous framework for capital allocation. Not every dividend-paying company is suitable for DDM. We look for stable payers, characterized by mature market positions and robust balance sheets. Specifically, we target companies with consistent 40 to 60% payout ratios. This range is the Goldilocks zone. It shows the company is profitable enough to reward shareholders while retaining enough capital to fuel the growth rate G. We also look for businesses in defensive sectors like utilities or consumer staples, where cash flows are less sensitive to economic cycles. For our angel partners, these companies represent the anchor of a diversified portfolio, providing the liquidity needed to fund higher-risk venture bets. When the payout is predictable, the DDM becomes an incredibly accurate tool for determining if a stock is a bargain or a trap. The denominator R in our equation is perhaps the most critical variable. It is the cost of equity, or the return we require to justify the risk. To find R, we often use the Capital Asset Pricing Model, or CAPM. This involves looking at the risk-free rate, usually the yield on a 10-year treasury, and adding a market risk premium adjusted by the company's beta. A stable payer typically has a beta below 1.0, meaning it is less volatile than the broader market. For our investors, a lower R means a higher intrinsic value. Understanding the components of R allows us to adjust our expectations based on the current interest rate environment. If the risk-free rate rises, our required return must also rise, which naturally compresses valuations, a vital consideration for any VC evaluating entry timing. The variable G represents the long-term sustainable growth rate. It is not just a random number. It is derived from the company's return on equity multiplied by its retention ratio. If a company earns 15% on its equity and keeps 40% of its earnings to reinvest, its sustainable growth rate is 6%. For stable payers, we expect G to be modest but incredibly consistent. It usually aligns with or slightly exceeds the long-term GDP growth. As investors, we must be wary of companies claiming a G that is higher than their required rate of return, R, as that is mathematically unsustainable in the long run. By strictly defining G, we ensure our DDM outputs are grounded in accounting reality rather than optimistic projections, protecting our partners' capital from overvalued growth traps. In the world of professional investing, we are never looking for fair value. We are looking for a bargain. This is where the margin of safety comes in. Once we calculate our intrinsic value using DDM, we compare it to the current market price. We generally look for a 15 to 20% valuation buffer. This discount accounts for potential errors in our G or R assumptions and protects us against unexpected market downturns. For our VCs and angel partners, this margin is the difference between a mediocre return and a home run. It allows us to be wrong about the details, but right about the investment. By insisting on a margin of safety, we institutionalize discipline, ensuring that every dollar we commit has a built-in cushion against volatility and unforeseen macro events. Let's put theory into practice with a concrete example. Imagine a company currently paying a dividend of $2.50 per share. We expect this dividend to grow at a steady rate of 3% per year. After assessing the risk profile and the current interest rates, we determine our required rate of return is 8%. Using our DDM formula, we calculate the intrinsic value by taking $2.50 and dividing it by the net of 8% minus 3%. This gives us a calculated value of $50 per share. If the stock is currently trading on the exchange for $42, we have found a significantly undervalued asset with an 18% discount. This is the exact type of opportunity we present to our partners, a mathematically sound investment with a clear path to value realization and a consistent yield. As we conclude, remember that the dividend discount model is more than just a formula. It is a philosophy of disciplined investing. For VCs and angel partners, incorporating DDM-based stable payers into a broader strategy provides a foundation of wealth preservation and compounding yields. While high-growth startups offer the potential for massive multiples, these stable assets provide the consistent cash flow that sustains a long-term investment vehicle. By identifying companies where the intrinsic value exceeds the market price, we create a portfolio that is resilient, predictable, and optimized for risk-adjusted returns. We invite you to join us in applying this level of rigor to every investment decision, ensuring that our capital is always working in the most efficient and mathematically sound way possible. Thank you for your time and partnership.